Hello, the Fed was in the news again this week, so I wanted to once again criticize them a little bit, and I think necessarily. Now, you can check out some other videos where I criticize some of the Fed actions if you follow these two videos. But again, I want to say that number one, I do think that some action was necessary due to the COVID crisis. Okay, number two, that their actions often create distortions in the economy that are not healthy. Number three, that they often need to act to counteract the negative consequences of their previous actions. And number three, that they err on the side of too low for too long. And that seems to be the plan here again. And why do I say that? I say that because if you look at the news this week, the Fed is saying that they're going to keep interest rates at zero for at least 3 years, right? They're already saying that. It's going to be 3 years where they even think about raising rates. You can see lots of headlines here. Doesn't make a lot of sense to me. I think we should let it be fundamentally economically driven, what happens, and also keep in mind that in general, they have been too slow to raise rates. Why do I say that? Well, let's take a look at this chart of rates over time. And if you look at this period from the financial crisis, '08, all the way through 2016, you can see that interest rates were essentially zero. I'm going to argue, as I have many times before, that they needed to raise interest rates much sooner. And if you look at this period here, interest rates should have been above zero, and they weren't. Well, why do I say this? Well, let's, for example, look at the Taylor rule. Now, the Taylor rule is a couple different forms of that, but every single one of these shows that rates were too low for too long. Okay, even again, the most aggressive sense, they would have been raising rates a year or two after the financial crisis. And in the worst case scenario, they would have been raising them, several years before they actually did. There's a problem here. Rates for too low for too long. We need to kind of follow the data. Also, I'm not the only one. There are criticisms of low rates from the Fed. We see crazy imbalances in the financial sector, which I've said it can cause excessive risk taking, which I've said they're basically daring you to buy stocks and risky assets. Right? It can lead to financial instability, especially as leverage increases because returns are lower, right? And because there's financial instability, then it can make the recession more severe. It can also make it more difficult for the Fed's actions to have any kind of effect on the economy when they're so low for so long. And in general, they say like some kind of an equilibrium interest rate or the Wilkinson I rate is ideal. To give you a sense of what that looks like, here's a chart here. Again, rates for too low for too long, post-financial crisis. And by the way, all these criticisms of the Fed, they're not mine. Well, they are mine, but they also came directly from the Fed itself. The Fed knows that these low interest rates are dangerous, and yet they still err on the side of keeping them too low for too long. So again, what I'm asking you to do is don't drink the Kool-Aid. Think for yourself. What should interest rates be given the actual environment, as opposed to putting, a 3-year price tag on things, saying, look, interest rates are going to be low basically forever. We're going to do everything we can to keep interest rates low and inflation high. Not the way to go, if you ask me. Anyway, thanks so much for listening.